Part 1. Definition of inventories. When we refer to inventories in accounting, we are speaking about assets that are critical to a business's operations and financial health. According to the International Financial Reporting Standards, IFRS, and Accounting Standards for Private Enterprises, ASPE, inventories are defined broadly to include three main categories. 1. Items held for sale in the ordinary course of business. 2. Items in the process of production for such sale. 3. Materials or supplies to be consumed in the production process or in rendering services. Let's break these categories down further. This refers to the goods a company intends to sell to its customers. These are the finished products that are ready for sale. For a retail business, this could include everything in the store, from electronics to clothing. For a manufacturing company, it refers to the products that have completed the production cycle and are now ready to be sold to customers. Example, a car dealership's inventory includes all the cars sitting on the lot, waiting to be purchased. These are finished products ready for sale, and they form a significant part of the company's total assets on the balance sheet. These items are critical because they represent the company's ability to generate revenue. Without sufficient inventory available for sale, a business could face lost sales and reduced income. The management of these inventories is essential for sustaining business operations and fulfilling customer demand. 2. Items in the process of production for sale, work in progress. This category is often referred to as work in progress, WWP. These are goods that have not yet been completed but are in the middle of the production process. For manufacturing businesses, WIP is a crucial inventory category because it represents partially completed goods that will eventually become finished products. IWIP includes all the costs incurred during production up to the current stage of completion. This includes the cost of raw materials, labor, and overhead. Managing WIP is critical for understanding a company's production efficiency and for valuing inventory at any given point in time. Example, in a furniture manufacturing company, work in progress might include partially assembled chairs and tables. They haven't yet reached the finished stage but are well on their way. From an accounting standpoint, it's important to note that WIP is usually measured at the cost incurred up to the point of measurement. This valuation includes not only the cost of the raw materials used, but also direct labor costs and allocated overheads. 3. Materials or supplies to be consumed in production or rendering services. Raw materials. The third category of inventory consists of raw materials and supplies that a business plans to use in the production of goods or the delivery of services. These are the foundational components necessary for creating finished products. For a manufacturing company, this might include metals, plastics, or textiles. For a service-oriented company, raw materials could include supplies needed to perform services, such as tools and cleaning agents for a cleaning company. Example, a bakery's raw materials inventory includes flour, sugar, eggs, and other ingredients. Without these essential components, the bakery would be unable to produce its goods for sale. The accurate accounting and tracking of raw materials are critical for efficient production planning and cost control. Overpurchasing can lead to excess storage costs, while underpurchasing can result in production delays. Key accounting considerations for inventories. It's important to note that inventories are current assets, meaning they are expected to be sold, used, or consumed within the operating cycle of the business, which is typically 1 year. Accurate valuation of inventory is essential for proper financial reporting, as it directly impacts the cost of goods sold, COGS, and the company's profitability. Mismanagement or misstatement of inventory can lead to significant distortions in financial performance. For businesses following IFRS or ASPE accounting standards, inventories must be carefully measured and reported. The standards outline that inventory should be measured at the lower of cost and net realizable value, NRV. This means that if the value of the inventory has decreased, it must be written down to reflect its true market value, preventing overstatement of assets on the balance sheet. Conclusion. To summarize, inventories are essential assets that drive production and sales in a business. They encompass items held for sale, goods in progress, and raw materials. Proper classification and management of inventory are crucial for accurate financial reporting and efficient operations. Whether finished goods on the shelf, partially completed products on the assembly line, or raw materials waiting to be used, inventories are a lifeline that keeps businesses running smoothly. Part 2. Cost measurement. Now that we understand the definition of inventories, the next critical topic is cost measurement. Accurate cost measurement is essential because it affects how inventories are valued on the balance sheet and the cost of goods sold, COGS, on the income statement. The accounting standards, whether under IFRS or ASPE, require that inventories be measured at the lower of cost and net realizable value, NRV. Let's break this down. 1. The concept of cost in inventory valuation. When we talk about the cost of inventory, we're referring to all the expenses incurred to bring the inventory to its present location and condition. It's not just the purchase price, but includes a variety of associated costs. The cost of inventory generally includes the cost of purchase, e.g., the amount paid to acquire the inventory, the cost of conversion, e.g., manufacturing expenses to turn raw materials into finished goods, any other costs necessary to bring the inventory to its current state. Let's look at each of these in more detail. 2. The lower of cost and net realizable value, NRV, rule. This rule is a fundamental accounting principle. It ensures that inventory is not overvalued on the balance sheet. According to this principle, inventory is recorded at the lower of cost, the actual price or expense incurred to produce or purchase the inventory. Net realizable value, NRV. This is the estimated selling price of the inventory in the ordinary course of business, less the estimated cost to complete the product and the cost necessary to sell it, such as marketing, shipping, or commissions. In simple terms, the NRV is the expected selling price after subtracting all costs necessary to finalize and sell the product. Here's an example. Imagine you own a company that produces custom furniture. You have a table in inventory that cost you $500 to manufacture. However, due to market changes, you now expect to sell it for only $400, and it will cost you $50 in marketing and delivery fees to make the sale. In this case, the NRV would be $350, $400 selling price minus $50 costs. And because $350 is lower than the $500 cost, the inventory would be valued at $350. This avoids inflating the company's assets by keeping inventory recorded at a realistic, recoverable value. 3. Understanding the cost of purchase. The cost of purchase goes beyond just the price you paid for the goods. It also includes shipping costs to receive the inventory, the freight charges involved in bringing the inventory to your business, duties and unrecoverable taxes, any tariffs or import taxes you cannot recover, purchase discounts or rebates, any reductions in the purchase price are deducted from the cost. Example, a retailer purchases 100 units of electronics for $10,000. In addition, they pay $500 for shipping and $1,000 in import duties. If the retailer receives a $500 rebate from the supplier, the total cost of purchase becomes $11,000, $10,000 plus $500 plus $1,000, $500 rebate. It's crucial to capture all these costs because they reflect the true economic outflow associated with acquiring the inventory. 4. The cost of conversion. For manufacturers, the cost of conversion includes direct labor costs, the wages paid to workers who are directly involved in converting raw materials into finished goods. Manufacturing overheads. These are indirect costs such as utilities, factory rent, and depreciation on production equipment, which are allocated based on production activity. Example, a company that manufactures furniture incurs $5,000 in raw materials, $3,000 in direct labor costs for the assembly workers, and allocates $2,000 in overhead costs for things like electricity and maintenance of machinery. The total conversion cost is $10,000. Conversion costs are critical for valuing work in progress and finished goods, as they represent the transformation of raw materials into a sellable product. 5. Costs that are excluded from inventory valuation. Certain costs, although related to inventory, are not included in its valuation. These include storage costs, unless they are necessary during the production process. Storage costs are generally excluded from the cost of inventory. Administrative overheads. These are not directly linked to production and are therefore excluded. Selling costs. Costs like marketing, distribution, and shipping to customers are also excluded from inventory valuation. These costs are expensed as incurred. Example, a company pays $2,000 to store excess inventory in a warehouse after production. This storage cost is not added to the value of inventory, but is recorded as an expense in the period in which it occurs. 6. Applying the lower of cost and NRV in practice. In practice, businesses must regularly assess whether the value of their inventory has declined. Inventory write-downs occur when the NRV falls below the recorded cost. This adjustment ensures that the inventory is reflected at a value that the company can reasonably expect to recover. Example: a fashion retailer has clothing inventory that initially cost $50,000. Due to a shift in fashion trends, the estimated selling price of the clothes drops to $40,000, and after considering selling costs, the NRV is $38,000. The inventory must be written down from $50,000 to $38,000 to reflect the reduced market value. Why this matters. The lower of cost and NRV rule prevents overstatement of a company's financial position. If inventory is overvalued, it can artificially inflate the company's profitability and asset base. Conversely, writing down inventory when necessary ensures a realistic view of financial health. Conclusion. To conclude, cost measurement is an integral part of inventory accounting. By measuring inventory at the lower of cost and net realizable value, businesses maintain accurate and conservative financial statements. This approach ensures that the inventory value on the balance sheet reflects the true economic benefit the company expects to gain, while preventing the overstatement of assets. Proper identification of costs, including the cost of purchase and conversion, and careful application of the lower of cost and NRV principle, are crucial for sound inventory management. Part 3. Cost components. When valuing inventory, it's essential to understand the various components that make up its cost. Inventory costs are more than just the purchase price of goods or raw materials. They include all expenses necessary to bring those goods to their current location and condition. Let's dive into the different elements that form the cost of inventory as outlined by both IFRS and ASPE standards. 1. Cost of purchase. The cost of purchase includes the amount paid to acquire the inventory, but it doesn't stop there. There are other related costs that must be considered, such as purchase price, the invoice price paid to suppliers, shipping and handling, any freight or delivery costs incurred to bring the inventory to your business, duties and taxes, any import duties, tariffs, or unrecoverable taxes paid on the purchase of the inventory, trade discounts and rebates. These reduce the cost of purchase. Any discounts provided by suppliers or rebates received should be subtracted from the total cost of the inventory. For example, a retail store purchasing electronic goods from overseas will pay the supplier's invoice, along with shipping costs to bring the goods to their warehouse and import duties imposed by the government. If they receive any trade discount, the total cost of purchase will be the invoice price plus shipping and duties, less the discount received. These costs are included because they are directly attributable to getting the inventory to a saleable state. Without these expenses, the inventory would not be in the business's possession, ready for sale. 2. Cost of conversion. For businesses that manufacture goods, the cost of conversion is crucial. The cost of conversion includes expenses related to transforming raw materials into finished goods. These are broken into 2 categories. Direct labor, the wages and benefits of employees directly involved in the manufacturing process. For example, assembly line workers or machinists who physically create the product. Manufacturing overhead. These are indirect costs that are allocated to the production of inventory. Manufacturing overhead includes costs such as depreciation of factory equipment, utilities, e.g. electricity used to run machines, maintenance and repairs on manufacturing facilities, factory rent and property taxes. A car manufacturer, for instance, incurs costs for the steel used to make vehicles, raw materials, the workers who assemble the cars, direct labor, and the factory's electricity rent and equipment depreciation, manufacturing overhead. All of these costs are essential to the production process, and they form the total cost of conversion. 3. Other costs. Beyond the cost of purchase and conversion, there are other costs that may be necessary to bring inventory to its present location and condition. These include costs of designing products for specific customers. For example, if a company customizes furniture to meet a client's specifications, the design costs incurred as part of that customization are included in inventory costs. Cost of transporting inventory to its place of use or sale. If inventory must be transported to another facility or retail location, these transportation costs are included. However, not all costs related to inventory can be capitalized. Some are specifically excluded. 4. Excluded costs. There are several costs related to inventory that are excluded from its valuation under IFRS and ASPE. These include storage costs. Any expenses related to storing inventory after it is ready for sale should be expensed as incurred. The only exception is if storage is a necessary part of the production process, for instance, wine aging in a cellar. Administrative overhead. These are costs like salaries of administrative staff, office supplies, and other expenses that are not directly tied to the production process. They should not be included in the inventory valuation. Selling and distribution costs. Costs related to marketing, advertising, shipping goods to customers, or sales commissions are also excluded. These are considered operating expenses and are recognized when incurred, not when the inventory is purchased or produced. Example, a company that sells consumer electronics pays to store its products in a warehouse and ships them to customers. While the cost of transporting the inventory to the warehouse may be capitalized, the warehouse storage costs and the shipping costs to customers are excluded from the inventory's valuation. These costs are recorded as expenses in the period in which they occur. 5. The importance of correctly classifying costs. Understanding which costs are included in and excluded from inventory is crucial for accurate financial reporting. Including irrelevant costs could inflate inventory values and lead to misstated profits, while excluding necessary costs could understate inventory and result in lower profits. Accurate classification also ensures the proper allocation of expenses to the correct accounting period. Example, if a company incorrectly includes selling costs in the inventory, it would increase the value of the inventory on the balance sheet and reduce expenses on the income statement. This would overstate profits in the short term, which could lead to misleading financial statements. 6. Capitalizing borrowing costs. In certain situations, borrowing costs incurred to finance the production or purchase of inventory must be capitalized. Under IFRS, IAS 23, companies are required to capitalize borrowing costs directly attributable to the acquisition, construction, or production of qualifying inventory. A qualifying asset is one that takes a substantial period of time to prepare for use or sale. This could apply to large-scale construction projects or long production cycle goods. Under ASPE, Section 3031, companies have the option to either capitalize borrowing costs or expense them as incurred. The choice will depend on the company's financial strategy and accounting policies. Example, a construction company financing a multi-year project to build custom homes would capitalize the interest on its loan as part of the inventory costs until the homes are completed and ready for sale. This reflects the true cost of creating the homes, including the cost of financing. Conclusion. To sum up, the cost components of inventory include all costs necessary to bring the inventory to a saleable state. This includes the cost of purchase, conversion, and other necessary expenses, but excludes storage, administrative, and selling costs. The proper classification of these costs is vital for accurate financial reporting, ensuring that inventory is valued correctly and profits are neither understated nor overstated. Whether under IFRS or ASPE, following these guidelines ensures transparency and consistency in financial statements. Part 4, Cost Flow Assumptions. Once we've determined the cost components of inventory, the next step is understanding how those costs flow through a company's financial statements. This brings us to the concept of cost flow assumptions. These are the methods used to track the movement of inventory costs as goods are purchased or produced and eventually sold. While the physical flow of inventory can vary, accounting rules allow us to choose from specific methods to assign costs to the inventory sold, and by extension, to the remaining inventory. Let's dive into the two main cost flow assumptions, first in, first out, FIFO and weighted average. 1. Why cost flow assumptions matter. Imagine a business that buys inventory over time, with varying costs due to price fluctuations. Each batch of goods might have been purchased at a different price. When the company eventually sells its products, it needs to decide which cost to attribute to the goods sold and which cost to attribute to the inventory remaining on hand. This is where cost flow assumptions come into play. The goal is to systematically apply one of the accepted methods to maintain consistent and transparent financial reporting. The chosen method can significantly affect both the company's cost of goods sold, COGS, and the ending inventory value on the balance sheet. For example, if a company buys inventory at different prices and chooses to sell the oldest inventory first, under FIFO, its COGS will be lower during periods of rising prices, leading to higher profits. However, if it uses the weighted average method, it will smooth out the price fluctuations and report a more consistent cost for both inventory sold and inventory remaining. 2. First in, first out FIFO. The first in, first out FIFO method assumes that the oldest inventory is sold first. This means that the cost assigned to the goods sold is based on the price of the first units purchased or produced, while the remaining inventory on hand is valued at the most recent costs. How it works. Imagine a company purchases 100 units of inventory in January at $10 each and another 100 units in February at $12 each. By the end of March, the company has sold 150 units. Under FIFO, the company would assume that the 100 units purchased in January were sold first, followed by 50 units from February. As a result, the COGS would be 100 units x 10 plus 50 units x 12, $700. The ending inventory would then be 50 units at $12 each, for a total of $600. When to use FIFO? FIFO is a natural cost flow assumption for businesses where inventory physically moves in a first-in, first-out manner. For example, in the grocery industry where perishable goods are sold, the oldest products are typically sold first to prevent spoilage. Effects of FIFO. In periods of rising prices, FIFO will report lower COGS since older, cheaper inventory is assumed to be sold first, and higher ending inventory values because newer, more expensive goods remain in inventory. In periods of falling prices, FIFO will report higher COGS since older, more expensive inventory is assumed to be sold first, and lower ending inventory values. This method ensures that the value of the ending inventory reflects the most recent purchase prices, which may provide a more accurate representation of the inventory's current market value. 3. Weighted average cost method. The weighted average cost method smooths out price fluctuations by calculating the average cost of all units available for sale during the period. This average is then applied to both the inventory sold and the inventory remaining on hand. How it works. Suppose the same company buys 100 units of inventory in January at $10 each and another 100 units in February at $12 each. By the end of March, it has sold 150 units. Under the weighted average method, the company calculates the average cost per unit, 100 units x 10, plus 100 units x 12. 200 units are $11 per unit. The COGS would be 150 units x $11 or $1,650. The ending inventory would be 50 units x $11 or $550. When to use weighted average? The weighted average method is ideal for businesses with large quantities of interchangeable goods, where it is impractical to track specific items. For example, manufacturers of raw materials or retailers of commodities often use the weighted average method to simplify their accounting. Effects of weighted average. The weighted average method produces a consistent cost for both COGS and ending inventory, regardless of price fluctuations. This can be advantageous during periods of price volatility, as it evens out the effects of changing prices. 4. Choosing between FIFO and weighted average. The choice between FIFO and the weighted average method depends on several factors, including the nature of the business, the type of inventory, and the financial strategy of the company. Considerations for choosing FIFO. FIFO is preferable when inventory costs are rising, as it results in higher ending inventory values and lower COGS, which can boost reported profitability. Businesses in industries where inventory is perishable or time-sensitive, like food, pharmaceuticals, or technology, often favor FIFO, as it aligns with the natural flow of inventory usage. Considerations for choosing weighted average. The weighted average method is useful when there are frequent purchases of identical or similar products, and tracking individual inventory costs is challenging. It provides stable and predictable results, making it easier for companies to manage costs and plan for the future. In industries where prices fluctuate significantly, such as raw materials or commodities, the weighted average method offers the benefit of smoothing out the impact of price swings. 5. The accounting impact of cost flow assumptions. It's important to note that the choice of cost flow assumption affects more than just inventory values. It also impacts a company's financial performance. For example, during inflationary periods, FIFO will typically result in lower COGS and higher profits. because older, cheaper inventory costs are matched with current revenues. On the other hand, the weighted average method will result in higher COGS than FIFO, leading to lower reported profits but smoother cost calculations over time. On the balance sheet, FIFO results in higher inventory values during periods of rising prices, which can make a company's financial position look stronger. In contrast, the weighted average method offers a more conservative view of inventory value. Finally, once a business selects a cost flow assumption, it is important to apply that method consistently. Changing the method too frequently can create confusion and lead to inconsistencies in financial reporting. Both IFRS and ASPE require consistency in the application of inventory valuation methods to ensure comparability of financial statements over time. If a change in method is warranted, it must be disclosed in the financial statements, along with the rationale for the change. Conclusion: cost flow assumptions, whether FIFO or weighted average, play a crucial role in inventory management and financial reporting. Each method has its advantages and implications for a company's COGS, profitability, and inventory values on the balance sheet. FIFO reflects the actual flow of goods for many businesses and tends to result in higher profits during inflationary periods, while the weighted average method provides more stable and consistent results, especially for businesses dealing with fluctuating prices or large volumes of similar goods. The choice of method should align with the company's operational needs, and once chosen, consistency is key for clear and transparent financial reporting. Part 5. Net Realizable Value, NRV. When valuing inventory, one of the most critical concepts to understand is Net Realizable Value, NRV. It serves as a safeguard against overvaluing inventory on the balance sheet, ensuring that the value of inventory reflects what a business can actually recover through sale. According to IFRS and ASPE standards, inventory must be measured at the lower of its cost, or NRV. But what exactly does NRV mean, and how is it calculated? Let's explore this in detail. 1. What is Net Realizable Value, NRV? NRV is the estimated selling price of an inventory item in the ordinary course of business, less the estimated costs of completion and the estimated costs necessary to make the sale. It essentially represents the amount the business expects to realize in cash once the product is sold, after accounting for any additional costs needed to complete or sell the product. In simpler terms, NRV answers the question, what can we realistically expect to receive for this inventory after we've done everything necessary to sell it? 2. NRV calculation. The formula for calculating NRV can be broken down into two key components. NRV, estimated selling price, estimated costs of completion plus estimated selling costs. Let's break this down. Estimated selling price. This is the price at which the company expects to sell the inventory in the market. It reflects current market conditions and customer demand. Estimated costs of completion. If the inventory is not yet finished, such as work-in-progress goods, this includes the cost of finalizing production. For example, a partially completed car on an assembly line still requires assembly labor and components to become a finished product. Estimated selling costs. These are the costs necessary to sell the inventory. This might include shipping, marketing expenses, sales commissions, or warranty costs that the business expects to incur once the sale is made. 3. NRV in practice. Let's look at a practical example to see how NRV works in real life. Imagine a company that manufactures electronics. It has 100 units of a smartphone in inventory, which it initially produced at a cost of $200 each. The estimated selling price for each unit is $300. However, before selling the phones, the company needs to install software and package them for sale, which will cost an additional $20 per unit. Furthermore, it expects to spend $10 per unit on shipping and marketing. In this case, the NRV is calculated as NRV per unit 300, 20 plus 10, U270. Since the NRV of $270 is higher than the cost of $200, the inventory is valued at cost. If the NRV were lower than the cost, the company would write down the value of the inventory to the NRV, preventing an overstatement of assets on the balance sheet. 4. The importance of NRV in inventory valuation. NRV is important because it ensures that inventory is not recorded at an inflated value. Businesses operate in a constantly changing environment, where product demand, production costs, and market prices can fluctuate. For example, a technology company might experience rapid declines in the market value of its products as new models are introduced or consumer preferences shift. Without the NRV principle, inventory could remain recorded at a value far above what the company could realistically sell it for. By measuring inventory at the lower of cost and NRV, businesses can ensure that their financial statements reflect realistic, recoverable values. This protects stakeholders, such as investors, creditors, and management, from relying on overstated financial information that could distort profitability and liquidity. 5. When NRV is lower than cost, inventory, write-downs. When the NRV of inventory falls below its recorded cost, the company must write down the inventory to its NRV. This is called an inventory write-down, and it's recognized as an expense in the income statement. This process helps match the inventory's current economic value with the company's financial performance. Example: a fashion retailer buys coats for $80 each, expecting to sell them for $120. However, due to unseasonably warm weather, demand plummets, and the estimated selling price drops to $90. Additionally, the retailer expects to spend $10 per coat on marketing and $5 on shipping. The NRV becomes NRV 90, 10.5, 75. Since the NRV of $75 is lower than the original cost of $80, the company would write down the inventory by $5 per coat to reflect the true market value. This write-down prevents overstatement of the inventory on the balance sheet and recognizes the loss in value on the income statement. 6. Reversals of inventory write-downs. Under IFRS, if the conditions that cause the write-down reverse in a later period, e.g. market prices improve or selling costs decrease, the write-down can be reversed up to the original cost of the inventory. This reversal is credited to the income statement, improving reported profitability. However, ASPE does not allow for reversals of inventory write-downs. Example: continuing from the previous case, if demand for coats suddenly rebounds and the estimated selling price increases to $110, with marketing and shipping costs unchanged, the NRV would now be NRV 110, 10.5, 95. In this scenario, the company could reverse the previous write-down, increasing the value of the inventory from $75 to $80, the original cost, and recognize the $5 gain in the income statement under IFRS. 7. NRV and different types of inventory. NRV applies to all types of inventory, including finished goods, ready for sale, with the NRV reflecting the net selling price after costs of sale. Work in progress, WIP, partially completed goods, where the NRV must account for both the cost of completing production and selling costs. Raw materials. If raw materials are no longer expected to be used profitably in production, for example due to a change in production plans or obsolescence, they must also be written down to their NRV. 8. Factors that can affect NRV. Several factors can impact the NRV of inventory, including market conditions. If consumer demand decreases or competitors offer lower prices, the estimated selling price may fall, reducing NRV. Cost of completion. If the cost of completing work-in-progress inventory increases, e.g., due to rising labor costs or delays in production, the NRV may decrease. Selling costs. Higher than expected marketing, shipping, or distribution costs can reduce the NRV of finished goods. Businesses must continually reassess the NRV of their inventory to ensure that it reflects current conditions, and that their financial statements are accurate and reliable. Conclusion. In conclusion, Net Realizable Value, NRV, is a key concept that ensures inventory is not overstated on a company's balance sheet. By measuring inventory at the lower of cost or NRV, companies protect themselves from reporting inflated asset values and provide a realistic view of their financial position. When NRV falls below cost, businesses must recognize an inventory write-down, reflecting the true economic value of their inventory.